Hello, my name is Mike Hetman, and welcome to another edition of CMS Forex News. Today is Wednesday, March 19th, 2008. The Bank of England meeting minutes showed that policy members were uncertain about the length and depth of the slowdown abroad and at home. Though manufacturing and the services sectors have been resilient, the picture in the financial sector is much murkier. The bank did not want to have back-to-back rate cuts because it is still concerned about inflation. However, there has been speculations of major financial institutions requiring emergency funding, although the bank denied any application for such funding recently. The Monetary Policy Committee will be hard-pressed not to lower rates in the next meeting on April 10th by at least 25 basis points. The number of unemployed persons in the UK declined by 2,800 in February. For the 17th straight month, that total employment has improved. The figure was lower than economists had expected, however, and the slowing economy may start shedding jobs. For now, consumer spending has been underpinning the economy as other sectors like housing and the financial sector struggles. UK manufacturing orders for March improved, beating economists' expectations by a large margin. Most of the increased demand came from foreign sources. The pound-dollar pair took a sharp turn downwards today. The fact that two members called for a rate cut increases the chances the bank will move in their next meeting to reduce rates. Since yesterday's Fed announcement, the pound is down 400 pips against the dollar. The Eurozone saw its trade balance deteriorate in January. In seasonally adjusted terms, the deficit widened to 2 billion euros, and the non-seasonally adjusted deficit registered a 10 billion shortfall. This was much larger than expectations and shows that the rising euro is cramping demand for euro exports. For the year, exports to the U.S. were down 3%. The euro-dollar halted its overnight rally at 1.5785 following the trade data. The pair had climbed 160 pips but turned back in favor of the dollar. The pair retested the 1.56 level around noon New York time and rebounded slightly. Canadian wholesale sales shook off a disappointing December and started the new year with a strong gain. The 2.6% increase effectively offset the drop from December. Despite the better fundamental news for Canadian wholesales, the US dollar-Canadian dollar pair surged in favor of the greenback. The main driver for the jump was a fall in commodity prices, particularly for oil and gold. Oil was down almost $5, while gold saw a steep $60 fall, in what may be a bout of profit-taking in those markets. The Forex markets may also be pricing in further rate cuts from the central bank, as the Bank of Canada is expected to follow the Fed in lowering rates. From its session low near 0.99, the pair crossed through the parity line and was trading near 1.01 as of 2 p.m. Eastern Standard Time. The Australian and New Zealand dollars also fell in New York trading, as they are closely linked to commodity markets. In this example of the Kiwi-US dollar, the pair swung almost 180 pips from its session high after rallying yesterday and overnight. The Kiwi had been bolstered by the Fed rate cut and gains in the local country's stock market. Today's fall was preceded by a head-and-shoulder pattern. Also, the finance minister Michael Cullen essentially forewarns a chance of a light recession as indicators start to head south. Coming up overnight, Germany and the Eurozone will release preliminary estimates for manufacturing and services activity for March. And Germany will also post its inflation to producer prices. Switzerland follows with its own producer prices and trade balance data. The UK, meanwhile, will unveil figures on retail sales. Tomorrow, the U.S. will reveal weekly jobless claims and its Philly Fed Index. Both Canada and the U.S. release their respective leading indexes. Finally, Canada will also reveal the amount of securities purchases by foreigners. And this completes Forex News for Wednesday. For CMS Forex, I'm Mike Hetman. Happy trading.